Good morning, traders. This is Michael coming to you from GammaEdge with our pre-market morning strategy and briefing session on Wednesday, April 2nd, 2025. We start off with our three pillars here at GammaEdge, as always, with our market trend model, and then we'll go into sentiment and structure, looking at the option structure via the SPXA and the SPXP, and then we'll finish off with our game plan. Heading into today, this obviously is our market trend model. We continue to see a shorter term recovery, but it's not a significant recovery overall. This market trend model is based off the tick. You can research that in Investopedia, but basically it is just the buying versus selling that is occurring in the overall market between market participants. And that just gives us a way of viewing who is winning the battle, buyers versus sellers. And then we aggregate that as a cumulative tick, which is the bolded white line you see here. And then we add a time series to give us a opportunity to glance at the overall change throughout the days and continuing to look at who is winning the battle, buying versus selling. So to reference really quickly, obviously the bolded CT is our cumulative tick. Again, that's just aggregated of the buying versus selling. If you are a bull, obviously you want to see the cumulative tick rising from lower left to upper right. If you are a bear, then you've seen this the multiple days down. The upper left to lower right indicates that there's more selling versus buying occurring. What we want to look for is the CT to start to recover above at least our shortest term moving averages. These are just reference points for us to look at. The colored ribbon is our longer term state, 30 plus days out. That continues to be in a bearish state and sellers continue to be in control. Up here we have our new highs versus new lows. Obviously you've seen this multiple days, market breadth. New lows continue to outpace new highs. It will be difficult for the market to have any sort of meaningful price appreciation. This blue cyan line here is our filtered cumulative tick. Basically, this filters out to larger orders of plus 1,000 or minus 1,000. Those are usually occurring via institutions. As you can see, it's actually sideways yesterday, even with the market recovering. And as we've noted, it's kind of meh. So we would like to see, as you've seen over here, the filtered cumulative tick extremely down. This is institutional selling rapidly to the downside, and obviously you get the appropriate price depreciation. If we want to see the price appreciation, you would need to see this flip and be above zero and then trending upwards like this, indicating that institutions are buying more than they are selling. So as of now, we've seen a short-term recovery, but now we're completely sideways. We're basically at a stalemate with the overall CT, even though we saw some price appreciation yesterday, but really did not see the confluence of the buyers stepping in and sellers really trying to maintain control. So we'll watch this intraday. This really gives us an idea of who's winning the battle and which side of the market you want to be on, long or short side. Heading into our SPXA, this is what we call the cruise ship. These are our quarterly and monthly expiries. These are institutional positioning in the options market. So these is very large notional value. We continue to be put dominated above and below spot price. As you can see, and we talked about this structure here is incredibly poor structure for the bulls, and that would be some price appreciation. So as you've noted, or as we can note here, there's a lot of red negative delta. This is in the money puts above us. This is not propensive of price moving higher as puts continue to dominate the overall structure. You would want to see this completely start to change to green, which means out of the money call speculation is coming into the market, and that would lead to most likely price appreciation. As we've noted below the yellow line, which is actually the closing spot price, we have seen some improvement. You can see the red negative net delta start to go away and some green start to creep in. Again, this is very early in the overall structure, turning from a bearish state to a bullish state. Again, this can fail very quickly with the overriding in the money puts and red negative net delta overhead. This may have been just a short-term profit taking or end of the month structure change, and then we may see this fill back in with red negative net delta, which would indicate out of the money put speculation coming back in full force, which that means market participants are speculating that price is going to go lower. So we'll continue to watch this again day over day, but again, you'll notice these are monthly or quarterly and monthly expiries. So these are not short-term dated delta or gamma. So that's why we like to look at this and look at the overall positioning of institutions to give us an idea of where they may position for weeks to months out in time. Heading to the SPX-P, this is our obviously shorter term expiries. You note that these are our daily, weekly expiries. So obviously this gives us a look through the options lens of short dated call and put gamma as well as delta. You do notice again over here that we are still put dominated. So as with the SPX-P, we do have significant amount of in the money puts above us. That is red negative net delta within the overall structure and complex. And we did see this improve slightly compared to the past previous days where this was completely red and dominated by out of the money puts. We do see some of the out of the money puts eroding and then in the money calls getting exposed. And you'll notice this by the green negative net delta. So these areas, as spot price moves down towards these areas, if these in the money calls are maintained and not closed within the overall structure, these can become supportive areas. Now, we'll note that the first order Greeks delta swamps all second and third order Greeks. So mechanically opening and closing of contracts, which would be opening and closing of puts, can completely swamp this overall structure. And these in the money calls can get swamped without the money put speculation very rapidly. So that could lead to, again, to more price depreciation. So as we discussed, this is very early on in the overall structure changing. This is the first step towards a multiple step, multiple day, week change of the structure from put dominated to call dominated. And this is how we identify turning points in the market. We have to have this first step below the spot price, which is the yellow denoted line here. These need to change to into money calls, which will become supportive as price moves down into those areas. And then we have to start changing these out of the money red negative net deltas from in the money puts to out of the money calls, indicating that call speculators are coming back into the market and speculating that price will continue to move higher. So denote also our transition areas. Those are extremely important as we always go over. It is fairly wide at the moment, 55 points. So we have key levels. An implied open will be below that key level of 5,600. And again, within the overall transition range, this can be a very choppy area where we tell traders that this will be very difficult to trade within the overall transitions, and it can be very choppy. So you need to shorten your time frame or really not trade at all. We would rather trade on the fringes of the transition as we cross those transitions or become rejected at those transitions from above from below or above. So we'll move on. We noted the VIX GEX ratio here, not really going to touch on that. And the SPX GEX ratio, this is basically your put call ratio, but we've added time component, which adds gamma to it. This is a short dated call versus put gamma. And as you can see, this red dotted line is really not improving much. So the short dated put gamma continues to dominate the complex, even though spot price or price did appreciate yesterday, but we did not see the overall recovery in the short dated call gamma, indicating that we are at a point that price appreciation can still be dampened pretty significantly without that out of the money call speculation coming in. All right, moving on to SPXP, 0 DTE expiry at the moment. Again, we are call dominated, which is a change today. We discussed that. So the call dominated just simply means that we do see in the money calls below spot price. Now, implied open is 55.75 down here. So at the time of running this web app, these in the money or these calls that were roughly around 5,600 were still in the money. Now, if we get it applied open below that at 55.75, these calls are now forced out of the money, which can become a headwind overall and above. And then we have the in the money puts above us, which obviously are negative net delta, which will also provide a headwind above. So the first key things we do here at GammaEdge is we identify the transitions. We see the GEX transition here at 56.20, 56.25. Obviously, implied open is below that. So that would be a first area where we'd see some sort of rejection. If you're a bull, you want to see price get above the transition and have the opportunity to move higher. If you're a bear, you would look for some sort of rejection of that transition. We look for DEX transition here, 5,600 to 56.25. So we had a significant confluence of 56.20 to 56.25. Obviously, that will be a key level overhead for price to come up to, and then look for it to get rejected within that overall area, or then move above, which would move to a more call dominated state, and we could have a price appreciation towards 56.60. So again, key levels identified. We have the drunken sailor range, which is obviously low exposure area where we anticipate a significant amount of chop back and forth within the overall structure. So again, we tell traders to shorten their time frames and manage risk appropriately. To the downside, 56.60. If we get below 56.60, we would look for us to move down towards that 55.50 and possibly the 5,500 level. We've talked about the JPM hedge being removed, which was supportive within this overall area. But we do have in the money calls below us, so we'll continue to watch this throughout the day. The GEX ratio, or sorry, the delta balances, the SPX still remains very bearish. We would like to see this, both of the left-hand plane and right-hand plane, denoted by the green and red lines, move above zero. That would be indicating that call speculators are coming back into the overall structure and complex, which we are not seeing at the moment. And the delta balance, which is your blue line, is the aggregate of the right-hand plane, which is above spot price, and the left-hand plane, which is below spot price, is aggregated down towards -1, indicating we are still in a significantly bearish state, and speculators are still in control of the overall structure and complex. Net stat command, this just gives us our highest sensitivity areas for the day. We've forced spot price to the implied open, and we've indicated obviously 55.50. We've discussed 55.60. Bottom of the drunken sailor range will be an important area this morning. As price comes into that area, it can be supportive, but if we get below that area, that can be indicating more weakness. And then to the upside, we have 5,600, which we've already discussed extensively, and the 55.75, that net gamma level, which will be our highest sensitivity level with this implied open. And as always, we'll be watching the vol-m command intraday. That will be indicating what market participants are doing on aggregate volume, and we'll discuss that throughout the day with everyone. Heading on, obviously, to the trading view chart. Let's see what our implied open is. So we're sitting at 55.74. So I've overlaid, obviously, the GEX ratio, or the GEX transition, DEX transition, and the overall drunken sailor range with our full complex script from TradingView. So as you can see, where we're going to open at 55.75 will be zero GEX. So that's the balance point between calls and puts within the overall complex, which is our full complex. So staying below that, we would lean a little bit more bearish. And then below the bottom of the drunken sailor range, obviously we'd lean significantly more bearish. Above the zero GEX within the overall drunken sailor range can be very choppy. And then we have the transitions above, which if we are below those, we're still indicating more bearish than bullish states. As well as respecting with the NTM and vol-m intraday. So hopefully that helps everybody pre-market. Again, look at the transition zones, look at the key gamma delta levels, and where we're opening at, and then who is winning the battle: bears versus bulls, and callers, or buyers versus sellers. And that will keep us on the right side of the market. So a little bit longer this morning. Hopefully that helps everybody. Wanted to go over all the content. We'll be in the Discord in just a few minutes to answer any questions, and everybody make it a great day. Thanks.